not to bring it? It's up to you.
I would just no.
I'm bringing it in case you're stuck.
Okay.
So no cheat sheets.
Yeah, it's fresh in my head.
Rick, I thought you said we're executives here.
We don't do this.
So executives need to understand the foundation of what they're doing. Sounds like calculus.
I don't know how we do it on calculator. No class.
Wait, we don't. Yeah. So okay. So what we need.
Take a picture of it because all the people are sitting there.
Guys, listen up, please. I want to ultimately see this. Guys, listen. Are you listening? I want to ultimately see this in a multi-columnar format, such that I can see cash flows, present value of the cash flows, the summation for those, and then I get to see the continuation term. And then I get to see the valuation.
Like we do in Excel.
Just like you do it on your spreadsheet.
It's the growth rate.
Okay.
Is that what it is?
It's actually very simple.
1 through 6.
You've done this a dozen times or more. And Lynn's done it for 3 straight semesters. Lots, right?
I'm an expert.
Has it really been 3 back-to-back?
I think so.
I think it has. I'm so sorry.
I know.
Terribly apart.
Dubai and then
Yeah, so we had 603 last summer. And then in the fall, or the spring. So it's 603 in the fall.
Yes.
And then we spring went to July. I'm so sorry, man. You deserve an A just for putting up there.
oh, that's a good one.
Do you want to type?
I didn't say I'd give it to you. You deserve it.
And then is there
Present value. Yeah, it's the PVDC.
the total?
Yes.
1 to 6 is 18%.
Cash flow, that would be 200,000.
We just write formulas, you want us to do the math?
So we need to get the present value of these cash flows.
Alright.
Hey, use it. Just do another 10.
Okay, well,
That one's still. Here's 2 more.
Oh, yeah. That's only for the continuing. So,
It's still 18%.
yeah, for the last one.
So last is 5%.
That's G9 plus. It actually should be G7. Oh,
Is this what's my salad?
yeah, that means that's G7 plus.
I thought there was one.
It's like frequency.
Yeah, it's G7 plus. Yep, sorry about that.
yeah, that's the one we use.
Present value is going yeah, so start calculating this by using this. What's the R? Oh,
504,
no, it's the black.
450, about 45.
And this is correct. So it might be the one that says R. There might be that.
Just start calculating the present value of the cash. You don't have to solve this. Maybe one person can do each one. So let's decide it out now. So maybe 1, 2, 3.
So we need to get 1 sugar.
They're all multiplied by R. I think we just find present value also. Yeah. So what we have to do is move this up.
Yeah, this is 1.
Yes, sorry.
What is the reason?
So sorry, should say that.
Instead of black, so it's R and it's
Yeah, so just do this.
Yeah. What's
2, 3, 6.
R is 50%, so that's our WAC. So 207,000. Yeah.
Well, whack is an all.
Yes.
One time.
Can you write it down? Because I feel like we
And
don't know the
then,
formula.
So the present value of your
just, when you're doing future value, your own payment. Right.
So 1 plus R, we always be
Present value, so this first one is gonna be that divided by what was that number up there? And 1 plus. And the power of.
Should we just
keep this?
Yeah, you don't need to use any decimals in your values, so that you don't need to give me pennies.
So.
I just don't know.
173 to the power 91.
Oh, you're
Okay, number
Okay,
7.
to the power 1 is
Oh,
916,504.
Take with A1, so number 2 would be 20.
So it would be whatever the amount is at whatever time.
Yeah, or you can do, he's still in the castle, that's all right.
Yeah. I got the same too.
So that's the present value.
It's the same thing.
Does that make sense? Yeah, right? She got the same. So what's wrong?
How do you know what the present value is?
Kevin basically was divided
Well,
by.
How is it different from that one?
I don't know what the present value
Oh,
is.
yeah.
No, because that's
Yeah, you want the present value.
Everyone will do the same present value, right?
I want to see.
Because it's the same text.
So there's.
No, because the formula for
Yeah.
the key value, the KDE is different.
Yeah, KTB only comes into play when we get our calculator to the second value. Yeah, so it's the same, it should be the same to here. Yeah. Once we start doing like things we do on our so we do the same. So we can copy that present value, right? Yeah, we're not just gonna wait for
Well, we can
that.
for that, but we don't want to wait for that.
Or we can copy that if you want.
1.15 squared.
Oh, is someone doing 2?
I will set it out.
Yeah.
So I'll do 4.
Okay, 4.
And divided by, we call 1 equal.
Yeah, that's what
Right?
Yeah, so we're doing 1 by 8. Right?
To the power of whatever.
Yeah.
Oh,
Yeah. That's how you're gonna use the denominator.
I never use these.
No, that's what
Red, white, 89.
Now, how do you reach it to the power? The carrot?
Yep.
You know, what's the aggregate?
So this is that
Let me go grab mine.
Okay.
You can use mine for the next one. Hey, was anybody else not here last week?
So that's the second year, right? Oh, I forgot how to save it. On point, because it would be 236. Divided by 230.
See, that's what I'm saying.
Hey, don't stop the ice.
No, let's do a double check.
Yeah, I don't think it's a third deal.
Good, because I'm using a different one right now.
They're just going one way, that's the same. Yeah, I don't know now.
What do you mean? We all have different formulas.
So now we start the same, we have to start the same. So present value, so
Oh, that was super
yeah, this is the power.
Yeah, no problem, yeah.
Power is-
Oh, okay, I see what you're saying.
Yeah,
It's all
yeah,
like
it's all these things, this kind of factor, the only difference is
So they're going to.
So really, all you have to change is the period, which is the year, right?
We're doing it
You
right.
have to change the, you change 10 to that, because the discount, 200. That's what I did. So you had payment 0, 230. Yeah. That's your formula. So that's how.
I'm doing the calculator, which is.
This is 1.
Oh, 1 of 5.
They got one of
Okay.
those, mom doesn't know his school schedule.
Okay, so
Oh, you know how to use
So you got it?
actually opened it last week.
He's using the form, the
I don't know what happened. I was like, why doesn't everybody else have? I'm so not using
Now we gotta
Steve got it down pat.
352, 360.
That makes like
post my own calculator now of this.
This one's not.
So when I do this kind of thing, I start by figuring all of my 1 plus RTs. So 1.15, I would store it through
And then here,
1.15
we do something
where
weird.
I store it.
Yeah, and then it's my
Then all I have to do is say,
Yeah, so now
So 170.
yeah.
I'm like,
So then I can do my cash flow divided by 3 call 1. So I just systematize it.
There is one rent, yeah, but it's not
According to you,
That
this lets you input notation.
divided by 1
It's
plus
just
R.
They're only this one.
The screen's clear. So
Now we gotta do.
I'm gonna recommend.
That's gonna teach you a lot. He's good when it comes to Excel. Yeah. Yeah, I have no idea how
So that's our summation. Low, right? But that's the
No, it's not.
Oh, I see it.
That's what I'm doing. This is where it starts with science.
And then the one, if my x is 6.
So this is present value. What is it?
Oh, wait, but.
It's the summation of all of these, right?
Yeah.
Then we get
So now
that's
that's
what it says.
I want to store that to a.
Is we did the multiple.
Yeah.
and then FCF.
STO is store.
Yeah.
Yeah. 3.5
I can
plus
store it
6.
to button 6.
What's this?
Because it has to be what's this power, that way I can know where it is. So now we gotta find the cash flow times.
That's where our KVD goes. Yeah, so basically, what I do is give it, which is already given, right? Give it,
Call 6.
interest rate, then we take that back. All you do is change it because you don't want
Calling it now. Store it. Why do
I think you do 2 steps.
White.
Because it's a
I think you should
Discount.
yeah. So we say 83 because that's whatever. When our
I do them, I say now, year 1, year 2, year 3.
yeah, because that's no
First solve for the last number. Solve for CPA. Thank you. It'll be. And then parentheses, 1 minus G is 0.5.
There's a black one
There,
down there.
I know.
G is 8. No. Well, 1
How do I know what
6.
the PV of my DCF is?
Wait, 9 plus? Oh, wait.
You
I think he meant 7 plus.
Yeah, it's
Okay,
a
so it's
Okay, so I guess, yeah, they fixed it.
Is that what you
Five.
You just have the
So
sum.
it would be 5.
Five.
So how did you get, how did you get?
Or no, I see, which is 6.85.
Which is 0.6.
16.85.
Are you guys doing the formula?
Oh, that's a 5, not a
And
3.
then here's another.
Oh, it's 5, 5, 6.
Yeah, 5 black.
It's all easy.
Wow.
That's why I'm asking how you got it.
I just can't tell you. Back then it's G.
Minus.
Not quite overt enough for you.
With the first 2 years, we had.
Okay, there we go.
So that's, is that green not working?
I got the bottom to remember.
Okay, go.
Let's
Let's go back to when we went to there.
We know what we're doing.
We already have the multiplier.
So
That's what it is.
You're about to use
That's the
CFP.
forward market multiple.
That's moving out. That's you said we could use a calculator.
You can.
You can.
I can tell you how to do everything for you. So here's the thing.
I don't get why
You want us to use formulas like
I think it might be
Yeah,
helpful.
I'm gonna.
So here's the thing, the present value of the discounted cash flow is the sum of the discounted cash flow, right?
Yeah, so is that this number?
Yeah, it's this number right there.
Okay, is that right? Is that right?
Of course he was, he's had me through some.
Yeah.
For the first part of the equation, that's exactly right.
And you guys.
Oh, when they're wrong.
Oh, I guess it just means the current. You take the
Yeah.
You good?
Yep.
Or you know,
Here.
divide.
This is TF.
Okay.
Okay, let's write the formula down and then plug the things in.
Yeah, so you total all these.
How about FCF?
Okay.
And now we're going to do the.
I know we did one thing, which happens to be in the computer.
That's, I don't know, I'm trying to follow the Excel thing. I'm trying to remember it too.
Yeah, it is TBCB. So that's how you
And
that.
there's one more.
Yeah, there was one thing you probably should do afterwards.
No class.
So is this number?
So here it
That's
is.
the formula.
Oh, right, yeah.
Divided by 1 plus.
So we don't this doesn't. Oh yeah, we don't have that one.
What is T?
We don't have this one. So we
Oh,
actually.
time is.
So what is it? 1 plus flat or 1 plus 1.15?
This is the sum
Yeah, 1.15.
of the present value of the discounted cash flow.
This is 7. By 0.1.
I see already final summation column. Also 5 values, but then we have some values divided by 1 plus 5.
So,
Yeah, so we have all of this, we just
well, yeah, so this.
divide that by 1 plus black to the power of 6.
Okay.
You got it. So divide that by, yeah.
I mean, you got it.
Another value.
Oh,
Yeah, this.
Yeah.
So the value.
CF, right? No, CF. Value. Okay, so this one is.
Oh,
Yeah, so it's that,
because it lives as a number.
I'm just.
But what is this actually?
And now you add.
This thing is right, bro, I don't know.
Yeah, I'm closing my eyes and that's how.
Don't use that one.
Okay, Deb, just that.
Well, not for this you did, that's a cash flow.
This is add these two.
Boom.
Which is why I have to keep it separate. Let's go home.
There may be some rounding
It's
errors.
off like a million.
Yeah, it's just rounding. Million here and there. It's okay.
Maybe not.
Well, let me see. You're wrong about 200,000. Let me see where. Hang on.
200,000.
Hang on.
Those are pennies.
Relax. Everyone's gonna live.
That's why Excel is the best. It stores everything for you.
Check that number.
Yeah, I just checked that. So we did 4 No, divided by 2.66. That was the number.
Divided by 2.66.
Which is 1. Yeah. 1 plus flat.
I know, we're all handicapped.
Oh,
It gives us 2.66. So this is the number I get.
So this is the number on top, so it's 4.
I think that's right.
80474.
And I
Wait, how do we get this? Well, no, this is all good.
Hey, what's your value? Where you're at? Yeah, you got the right.
387. No, that's okay, we did it off.
So about here, where is times 0 in
Well, then-
consideration?
Right here.
Oh, so which
So
is
it's
the
6
power of
1
1?
power 5. So
Well, not 1.
Power of
Oh,
six.
yeah.
Power of 6.
Oh, okay,
Seven.
okay.
Yeah.
So no black, this is first down.
That's true, that's when you made a mistake on the homework.
So what? That was 1.
Yeah, so this is 0, this is continuation.
Oh, so that's
Yeah.
So if we use some actual time 1, it's giving us a value at time 0, right? Time 1 gives us something at time 0. So I'm trying to figure out if we're using this number, time 0 is 6 years from now.
I'm gonna plug it in as well. I don't know. She's meeting with neurosurgeon tomorrow. And no, she's out. But she has to.
What's the whack rate? What's the?
The whack. The discounted rate. We don't have whack specifically, but the discount rate is 0.15.
It is very, very close. You are a tiny
50%.
round off.
Yeah.
Yeah,
They done? They got the easy one.
Is this right now? I'm just trying to understand why.
So basically,
A G is for the first 1 to 6 is 18%, 9 plus is 5%.
How is Kinsey doing?
How's Kinsey doing? I don't know. I know that she's meeting with the neurosurgeon tomorrow, but that's all I know. I haven't texted with her since last week, so bad. That water. Huh?
So we have 7 years, but this included year 7.
Yeah, I was it wrong.
You would notice that the difference between here
So
and
we
here
would have
is
failed
5%.
this part.
It's 5%.
Right.
So this is year
We have the
1.
wrong year. Get the wrong.
That's year 0. That's year 1. That doesn't belong. So now.
Hold on, can you give us a minute? Hold on.
But you are, you're going to find your answer up there. And you're going to start.
Remember this, the second abdominal.
oh, this is where it's and this is where actually.
Like, what the KBB model? Or when you become skinny, yeah. Maybe like acting smart. How does the KBB model have we can just yeah. You guys, oh, you don't know? It's like, she's like, you don't know? Oh, I should go to this office. He's so nasty with that.
Yeah, exactly.
Just like the names. What about the no plan, huh?
You have to use
You'd be like, oh, she knows her stuff. Like, with the whole class to clarify where we use time 0 and where we use time 1 for what data. Because I think we were all like, oh.
And there's another element. How is it, these are so because look at the numbers. I mean, well, that one.
Yeah, nice.
They are so why do you have all these the various or zero.
Yeah, close to right.
They should, right. So what very often going well, we said that sometimes because we're trying to figure out so you got to sit down a minute and I'm going to pick up where you left off.
I was getting a little bit different number. Yeah, a little bit though.
I wish you had the easy one. This one was pretty easy. You just had to have the other stuff. Yeah.
Damn it, you're like, oh, okay.
Switching out professors. But I told them to clarify, like, when are we using time
times 0. When are we using time 1? But he didn't. He's gonna like to the whole class. Yeah.
Yeah.
So are we good?
And that, don't change that. Don't change that.
He just said we were off by about 2,000, but it was probably like a rounding error somewhere. Yeah.
Well, whoever did that number did the power side. Oh, wait.
But he was like it's nothing.
No, this is the right number. Whoever did this did the power side.
In Excel, yeah, of course.
I don't think so. Let's figure it out. We'll be able to tell here.
Like for sure.
No, they got the same number. Okay, so hang on.
Yeah, we have rounding error, but it is the right number.
It's the right number. That finger in the right.
What?
Only a couple million now.
Do you know that a lot of baseball players come from my country? Dominican Republic.
All you do is add another decimal.
You born there?
No,
you grew up? Okay. Dang, here, I'm just from Salt
The
Lake.
capital of Santo Domingo?
I'm from Salt Lake. When did you come to
Yeah, that's like the tourist spot. Great, yeah. No, next time if you go again, you hit me up and I'll tell you the non.
Well, I'll tell you how, but it did.
The one that's by the capital.
He traveled. Got here. Other than that, people by state highway did.
I have no idea. Yeah, I don't know the name. When did I come to the US?
Even though this was
7 years ago.
That's what people love.
But I went to an American school back home.
You got that.
So I grew up learning everything in English.
Yeah, that's right.
Well, they should go through the legal way. They understand that half more than half of the people who are here don't have the resources to pay to come here. So they have no other option. It's probably been like
I feel so bad because of my family. They really want me to come back.
yeah, it's they're accustomed. They're like, they're technically
Yeah, my whole family is there.
and according to the tax
Well, my boyfriend. We've been together for 4 years. So yeah.
Okay,
So like 7
so focus. What I want to do, focus please. What I want to do is I want to first walk you through how you validate these largely hand-created numbers using your cash flow register, okay? Rather than using your spreadsheet. And the function is only very little different, but I think if nothing else what this little exercise showed you is that it might be helpful to know how to do this longhand. And helpful to know how to do it with the use of a calculator for your exponents and decimals, but not for just typing in equals NPV parenthesis, oh please save me, right? And so you've got to understand these things. Remember, there will be a small assessment in a couple of weeks, okay? There will be a small assessment in a couple of weeks.
I thought you were going to waive it for us.
I created it for you. I cooked all day. Okay, so first, before we even validate it, your numbers, your end values, 3,190,970, 3,191,165. Somebody from Europe wrote that. I don't know from where a 1 looks like a parrot. And then 3,192,561. These are all within hundreds of each other, right? And in this one over on the far left is only $2 off of my number. And $2 when you're dealing with 3 million, who gives a rip, right? Even at the biggest difference, maybe over here, $1,500. off of 3 million, it's insignificant. It's de minimis. And those differences are all simply because you didn't use any pennies and you only rounded to the second decimal places, exactly as you would do if you were doing it by hand. So you get pretty darn close. Okay? So I like all of these. Let me kind of walk through and think about why these numbers, using 3 completely different model forms that in the problem sets you've done heretofore have yielded different outcomes, right? But in this case, they yielded virtually, if not literally, identical outcomes. Why are they all so similar? Other than you did them right. Well, they are using expressly the same inputs.
I'm just thinking back to the homework. Is it maybe because the G that we're using is based on the numbers that we already have? Did you solve for G to find that G?
I might have solved for some to get them to all line up. You could solve for G to get them to line up, or you could solve for ROIC to get them to line up. But you can't get more than 2 of them to line up at a time. So when you do these kinds of things, when you come up with different outcomes, you have to stop and think, why are the outcomes different? This was the last question in your last homework problem, right? And some of you said, well, because we've introduced ROIC and FCF this and blah, 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 KVD that. And that wasn't incorrect, but it was incomplete. And we've said this 2 or 3 times over the last few weeks. The reason that some of these give different outcomes is because the G wasn't accurate. So what does that really mean? Well, if we have an ROIC of, what is it, 16.85%, that ROIC is going to be indicative of some growth because that's return on our capital, right? And that return reinvested in our asset lets us grow the asset. Remember our discussion about the sustainable growth rate, SGR, and the internal growth rate, and return on assets and return on equity, and how those really were functions of, or growth really is a function of those. Those tell us something about the company's ability to grow. Well, return on invested capital tells us something about the company's ability to grow. We're making the assumption that return on invested capital is being retained inside of the company, right? Whether it is or is not is a discretionary choice based on what the board of directors decides to do. But unless you're told it's being distributed out, it's not, and it should be being used to grow the asset. Otherwise, we're not protecting the interests of the shareholders. And our job as a board of directors, our fiduciary responsibility, is to seek for the best interest of our equity shareholders. So we're assuming it's all left inside. It's our growth. It's part of our growth mechanism. So when we introduce ROIC into the key value driver equation, it is working in tandem with the growth rate that we're using to get a number. Okay? These are all the same number because the growth rate that we use, the long-term growth rate we used in the FCF and the KVD were the same growth rate at our given ROIC, and it worked. Okay? Did we use a long-term growth rate really in our forward market multiple model? The continuation form, is G involved in the continuation form? Is it? How do we get it? There is, it's sort of, it's there, but it's almost masked.
In the multiple.
Yeah, so think about this. The equation is continuing value for the forward market multiple. Continuing value equals EBIT in time 1 times the multiple, right? Well, EBIT in time 1 in and of itself used some growth rate to get there because we grew from year 6 to year 7, and that is the 1 year, we grew it by 5%. So that was the same number we used in these others. Okay? But the multiple all by itself is indicative of a rate of growth. It's indicative of a rate of growth. In fact, I showed you the multiple at 5.56. But now think about this. Let's calculate it and do this with me. It's instructive. We know that EV/EBIT is equal to ROIC minus G divided by ROIC times WACC minus G times 1 minus T, right? So let's just start substituting numbers and see what we get for our multiple. So 0.1685 minus 0.05 divided by 0.1685 times 0.15 minus 0.05 times 1 minus 0.21. With your calculators, what does that mean?
$5.56.
Go figure. So I didn't just guess at that. I didn't just guess at it. I calculated it using that KVD form of the enterprise value multiple. Yes?
In an assessment, would you provide most of that information that you just did?
Like everything over here on the right?
Yeah.
Yeah. Oh, I might not provide this.
Yeah.
I might not provide this, but I might tell you what year it is. Right?
So as of what year should we know that it's 21?
Well, if I don't provide the tax rate, you guys have tax tables that I've given you that you'd have access to. Just believe me, you do. You have them electronically and you have them on paper. Okay? They're spreadsheets. They're embedded in every one of the Excel templates, or not every one, but many of the Excel templates. I would have to give you some discount rate, or I would give you the inputs that lets you calculate a discount rate. I could give you the market value of debt, or things that let you calculate the market value of debt. I could give you the market value of equity. I could give you the market value of preferred. I could give you the cost of debt, or the cost of equity, or the inputs that let you calculate all those things, right? This is all a story that we've been telling each other now for weeks, and that we've been building, virtually line upon line, if you will. So, and I would have to give you either some free cash flows, or some no plats and other inputs to get to free cash flows, or I would give you the inputs to help you create those for yourselves. Which right now you don't know how to do that, and within about an hour you're going to know how to do that. Okay? So I would give you all of those things. But I almost certainly wouldn't expect you to do it for a period of 6 or 7 years. If you can do this for 2 years, you can do it for 1,000 years, right? Okay. So, pardon me?
Just kidding. 1 for 2,000 years manually, but yeah.
I think she said, prove it to me. That's what she said.
No, I don't want to do 2,000.
We might let Adriana prove it to the rest of us.
I'll be off 5,000 instead of 2,000.
Right. Yeah, so if you can do 2 years of this, you can do anything, right? It's just more lines, it's repetition. So I certainly in an assessment wouldn't expect you to do 6 or 7 years. Yeah?
Can we go over now the time 0 and 1 and
Yeah,
when to
yeah.
use which?
Yeah, so let's think about this. So this is how you see me use a multi-columnar approach, such that we start with time 1 functionally. Sometimes I use time 0, real time 0, right now in this, but then the number I put there, I don't do anything with it if I'm trying to get the present value. To get the net present value, I might. Notice that there's an investment price up here of $2,300,000 we didn't use. Okay? I would use that if I was trying to get the net present value. In fact, you should try to calculate the net present value. It's super simple. It's something minus something. Okay? And it gives you the net present value. And we're going to prove that number to each other in a few minutes. So then, the base year is year 0, really. Year 1, in this case, I've given you all those year 1s. And so 1, 2, 3, 4, 5, 6, 7. And a couple of you had to think, okay, year 7, was that the last year of the explicit period, or was that the first year of the continuation? How would you determine that if you weren't told?
On the growth rate, the growth rate.
Right, because if you notice, the difference between these numbers is far greater proportionally than the difference between these numbers, right? This, as I go from year 6 to year 7, we grew up 5%. So if you don't know, you can look at your last sequence of growth and identify, well, was that 18, which means that it's part of our explicit, or was it at 5, which means it's part of our continuation, since you were given both the explicit and the continuation numbers, right? So you could do that. And then year 0 is the last year of the explicit period. This all works off of this equation. I know I've said this many times, and for some of you it's just finally really starting to sink in, and I love that it is. It all works off of an equational form. P0 is equal to D1 divided by R minus G, which is a specific form of value at time 0 is equal to some cash flow at time 1 divided by R minus G. Well, if this is a cash flow, and dividend is simply some form of cash flow, right? If this is a cash flow at time 1, then this value is as of time 0, which is the year before. And if we're going to discount this number, which in this case happened to be 4,804,290, if we're going to discount it back to today, we know we have to discount it back 6 years, because that's equivalent with time 0. So if I were you, if you're at all confused by this, I would set up exactly like this. 1, 2, 3, 4, 5, 6, whatever, and then note the last one is 1, and the one before it is 0. That will help you remember to discount it back by the number of years of the last year of your explicit period. Okay? It's terribly important. Now, as one of you found, there wasn't a big difference in outcome when you added yet another year, thinking that this was year 0 and that this was year 1. It only created like a $2,000 or $4,000 difference in the total value, because we moved by 15%. Excuse me, we moved by 18% here against a discount rate of 15%. Not much difference in those. So if our growth rate from one year to the next and our discount rate are the exact same percentage, the present value of the number won't change. If we're expanding it at 15% and then discounting it at 15%, the present value of those two numbers would be the exact same number. That's why it was so similar when you added that extra year inadvertently. Okay? Let's run this into any one of these. It won't matter which one. I want them to run excuse me, I want us to run them into a cash flow register on your calculator. But before we actually start clicking the keys, let's make sure we understand what we need to do. I think it's going to be clear to you that at time 0, we should go ahead and use 0. Okay? And at time 1, 200,000, all the way through time 5, 387,756. That's common for each one of these. But in time 6, we're going to use the cash flow in time 6 plus the continuing value, which also lives as of time 6, because it's as of continuation 0, right? So we're going to add those together. Why do we have to add them together? Why can't we just keep going? To get a net present value, or to get an internal rate of return, we have to have a finite series of values. We can't have an infinite series. And if we use this number and not some of this, then we are incomplete, right? So we're going to put in 0 times 0, and then these numbers, and our last number will be 457,552 plus 4,804,290. And then let's go ahead and use 15% as the rate, and then let's see what our present value is by clicking the net present value with a red and PV key. What's the first thing we're going to do? And when we clear all, what's it tell us? And what do they need to be? 1. The first thing we always do, Karen, is check to see what the periods per year. You know this already? Okay, so mine was at 12. So 1 red NPV, or 1 red PYR. And so 0, and I'm pressing the CFJ button right in the middle of the 3rd row. So 0 CFJ. And if you need a primer on this, I think it's video 4. My time value sequence walks you through this, if I remember correctly.
Video 4.
Is that right, Adriana? Is it right?
Yes.
Yep. Okay. I saw that you were doing this. I just didn't know what it meant. Okay. Okay. We got a worm. Okay. So we got 0 times 0, then 200,000 for 1, 236 for 2, 278.
Yeah, sorry.
Okay.
So this is for PB.
Sorry.
So okay, we're going to start over. How did I get, when I said for year 1 and then for year 2, how did I tell it year 1 and year 2? Yeah, so every time we press the CFJ key, it increments a year. So Courtney, what I did was I said 0 CFJ and it accepted it for time 0.
But before you did that, did you add anything else or just the?
No, we're just working on cash flows right now.
Okay, so you did one,
So I'm
one period per
clear
year.
all, clear all.
One period per
And
year.
then, Courtney and Darren, the CFJ key is the cash flow at any time. That's what the J means, any time.
Cash flow
At any time. J means, and J and I are simply subscripts for any point in time.
Okay, so after one payment per year,
Then 0 CFJ. And it tells us it took it for time 0.
okay.
And then we're going to say 200,000 CFJ. It tells us it took it for time 1. And then 236,000 CFJ.
Oh, maybe that's why.
278,480 CFJ. 328,606 CFJ. 387,756 CFJ. And now we're through year 5. Okay, so if you're working with me, catch up to me. Okay, so now before we do the next CFJ, we have to add the cash flow we get at in year 6, and we have to add to that the continuing value, which also lives in year 6. Okay, so I'm going to say 457,552 plus 480,4290 equals.
I have a question. What happens if you make a mistake?
Then you clear all and start over.
That's the worst.
And so,
Answer.
It's unforgiving. It's totally unforgiving.
for n was 0? Was it 0 for n? No.
0 for n.
No, so if I start all over again, so it's a long
Zero is
period.
cash flow zero.
5, 2, 6,
Hey guys, stop. We don't tell it in.
Okay.
The CFJ button, every time we click it,
Yeah.
it counts in for us.
Yeah.
Oh, so
That's what I was
1,
Yeah.
red, PYR.
Yeah.
And the PYR button's right up here under PMT.
Perfect.
Okay, so now,
Thank you.
okay, so we have, on our display, Dariana's about to have a coronary. It says 5,261,842, right?
Yeah.
CFJ.
Well, what's
put
that
that
number? I
CFJ?
can't see
What's
it.
what number?
The CV. I can't read it.
4,804,290. 4,000,000.
801? 804. The 4 B have an hour.
4,804,290. By the way, I noticed that several of you had some errors and got wrong answers or wrong notes on the homework because you added an extra 0 into a number or 2 4s instead of 1 with fat fingers. I tried to find those and give those points back to you because I was in a halfway decent mood. Don't count on that. Doesn't happen often. Okay, so we've added then this 457,552 plus 4,804,290. About why did we add those together?
Because that's a continuation.
Yeah.
Well, yes, I mean that's what this is, but why did we add it together? Can anybody help? Karen, why did we add this cash? Okay, Carlos, why did we add the cash flow times 6 with this number? Wes?
Is it saying that in year 6 lives, because in the calculations we're not going to sit there and plug in.
You can't do infinite, can
So
we?
we're basically, that number, the 480, is the infinite
That's right.
added on to the last year of the.
Yeah, that's exactly right. So this number is the sum of all of the cash flows that live in the future, past year 6. And it's as of year 6. So since that's all of the future ones as of this point, we add them to the cash flow for that year, and we've synthesized a finite series of values from an infinite series of values. Okay, we synthesize them. We have to, otherwise we can't find a return. The algebra doesn't know how to do infinite return. I don't at least. Is that a question, Matt?
Yeah, I don't see the difference in these. Everybody got like the same answer and needs the same inputs.
Exactly. The continuing values are all different. This got the continuing value from this equation. This got the continuing value from the KVD equation. This got the continuing value from the EV equation.
So the only thing that differs is the continuing value.
But the continuing values are the exact same number, but they're different equations that got that number. Because we had the right inputs. When the inputs are dead on accurate and correlated with each other, each of the equational forms will give you the same output, even though the forms are different. Okay, I know we're over here about to die, all right? So we've pressed CF, we've given it the last cash flow, right?
Yes.
Okay. Okay, so now what do you do next? Okay, so 15 I divided by YR, that's our rate. And then red MPV.
So enter 15%, did you do that?
Oh, yeah.
What's it give you?
Red and that. And then red
Kim?
That's right, I got it wrong.
I'm sorry, I can't hear Kim, guys. You need-
Why are we doing it, I guess, with the calculator versus just doing it that with the formula. You know what I mean? Because it's like we'd have to go through. Oh, I take it back.
I thought you would.
Yep, never mind.
Okay. So when you do that, what number do you get? Something?
Well, I lost it.
Okay, so we're going to do it again, because a bunch of them are different, right? Okay, we're going to do it again. We're not going to talk to each other. You're going to do what I tell you to do. Chris.
Can you say what the, am I supposed to get that 3.1?
3.1? Oh, you should get 3,190,972. Or something so close to that as to be loud.
3.15.
Okay, so I want you to don't talk to each other. Just do exactly what I tell you to do for once in your pathetic lives.
Oh!
I will, I promise. And I don't think you have pathetic. Okay. Carlos has it. The rest of us have interesting. Okay, all right. We're all set at 1 PYR, right? Okay. So 0 CFJ. 200,000 CFJ. And when we press the CFJ button, the screen says CF1. That tells you it accepted it for time 1. Okay. 236,000 CFJ. 278,480 CFJ. 328,606 CFJ. 387,756 CFJ. And it told us CF5 when we pressed the button, so we know it's for year 5. Now, you're doing what I tell you rather than talking. Whew, you guys are hard to handle. 457,552 plus 4,804,290 equals, and your screen should show 5,261,842 CFJ, and it responds by saying CF6. We've now given it all of the cash flows we need to give it. We've given it a finite series of cash flows, even though we have an infinite series that we expect in the future, because we've simplified and synthesized. Okay? Now we're going to type 15 I divided by YR. Okay? Okay? And now red NPV. And NPV is the second from the right and the second row.
I have a question. So if we have an investment, if we have a, we basically need to pay for the investment, we need to pay for the investment in
Listen up,
year
guys.
0, do we put a negative?
Exactly. So to actually find your real net present value, because what we just found is the present value, right? To find your net present value, you would do this sequence again. But in CF0, you would put, in this case, I would have you put $2,300,000 as a negative. Okay? Without doing that, you should be able to find the net present value, because it's the present value minus the investment, okay? Which should be around $870,000, right? $890,000. Please, Carlos.
We won't ever have the exact number in the formula world, but what will be the acceptable range?
What do you mean?
Okay, so it was off by 50,000.
Oh, good question. So that's going to be a function of some of the dynamic of the other numbers. So if your discount rate is 5%, your acceptable range of error would be different than if it's 15%, right? To the dynamic. I would tell you that in something like this, if you get within $5,000, you did it right. You may have used a different rounding scheme than Excel or the person next to you, okay? But you can't get that close on this and be wrong unless you're just extraordinarily fortunate, right? Good question, by the way. In fact, on bigger numbers, if we're valuing a company that has cash flows in the hundreds of millions, which let's face it, lots of public companies have, right? Then you may come up with a value, a net present value, or even a present value that's off by several $100 million, and it'll be correct within some rounding structure. Because the number you're going to be looking at is in the many billions. Well, if Brandon's talking to me about $75 billion, what do I care about 200 million? It's a rounding error. I won't even notice it at the end of the day. By the time the day's over, interest accruals will have given it back to me. Couldn't care less.
My question back to what I was asking about the different models. You said they're all the same number because we use the correct input, because we have perfect data.
Because we have perfect data.
So if we didn't have perfect data, you would pick the model that best represented the best, or that matched.
Yes, use the data you have available to you.
For the data you believe, right? Because you might have all these numbers from a publicly traded company, but there could be
or something like
footnotes on the free cash flow that said in year 5 they spent $2 billion on something.
And what's the data that's going to be wrong or right isn't those data points. It's going to be your growth rates, because that's the projected, that's the guess, right? The rest of this isn't much of a guess. Oh, you might say the WAC's a guess, and you wouldn't be terribly wrong. It's a very interesting, highly educated guess, right? But it's kind of a guess still. So it's either your growth rate or it's your discount rate. Those are really the only options. Matt?
That may have just answered. I was just looking at the equations for the PVCV notes. They were slightly different too for the different models.
They should have been the exact same equation. PVCV should be CV divided by 1 plus R to the T. And T should be 6, and R should be 0.15.
What about on the valuation model structure sheet where it has like the formulas for that?
See what you're looking at.
Like the free cash flow, KVD, program.
Oh, I'm going to use specific. It's okay. Okay. So what he's looking at is under PVCV. He doesn't see, it doesn't show here CV divided by something. It doesn't show CV divided by 1 plus R to the T. It shows what CV equals. So they're different, but each of those supernumerators is the continuing value. So in this case, FCF divided by 1 plus R to the T is the continuing value. Good question. If you will look at, and I want you to look at it right now, because I need to move on to another item. I have loaded into the Excel templates, and I've linked to this week, I believe, a file that is, it's called Value Comparison FCF KVD FMM, or something like that. Click on it, it will take you to my spreadsheet that shows you all of this, and you'll see the spreadsheet equations and everything, the functions, the whole bit. Okay, it'll even give you a note as to how I got all the right numbers, because I used the what if analysis function that's the goal seek. Okay, after you've looked at that, maybe next week I'll walk you through goal seek. What I need to do now is walk you through forecasts. Was this helpful?
Yes.
Okay, good. Took a long time. No, that's good. I'm okay with that.
Is that under Excel templates?
Yes. If you click on Excel template, it should take you to my website.
Yeah, what's it called?
It's 1.14, I think.
Yeah, it is.
1.4. FCF, KVD, and FMM. Yes, Mara.
So what does it mean when real times 0, not continuing value times 0? What does it mean when that's a positive number, not like a negative?
Okay.
What would that mean?
If it's a positive number, it's probably just a marker, like it's the base year number for the free cash flow, in which case we don't add that up, we don't find the present value of it, we don't put it in the summation, because it's already existed. And if we're trying to identify the number required to own the future cash flows, we only use the one that already existed to help us figure out what the future ones might be.
Okay.
This is only a marker.
Gotcha, okay.
Good question.
Since it wouldn't be like an estimated number, it would be an actual
We know it,
figure.
and it's historic.
Okay.
It's simply to help us know where we go next.
And then one more thing. Which I think I know the answer, but just to
Okay.
make sure. The free cash flows, those are estimated numbers based on the growth.
In this case, based on growth.
Uh-huh.
But I'm about to show you how to strengthen your estimates. Instead of being reliant on just some percentage growth rate year over year, because let's face it, if this is a real business, what's the likelihood that every one of these years, this company's cash flow grew by 15%? Or 18, whatever it was? It's not gonna happen. I mean, if it does, everything lined up in the unicorn was right before Santa Claus and the Easter Bunny, right? Okay, it just doesn't happen. So we need to get beyond that. So we need to think about how we estimate cash flows. The first thing we need to estimate is revenue. Okay? And we've talked through this some, so I don't want to spend much time here. But we'll hit it again next week, but we've talked about it before. The things that we might have to think about is what's the change in GDP? If we're thinking about a domestic firm, I'm guessing expected changes in GDP for the economy generally will be some kind of an input into our sales increases. If we think GDP is falling, we're probably not going to see a 20% increase in sales unless we have a very spectacular company, right? Or it's extraordinarily well managed. Maybe I have to think about the industry that our company is in. If the industry our company is in is expected to have a 12% increase in sales, and then my company probably is going to have an increase in sales, all things being equal, of not much different than 12%. But hopefully all things aren't equal. Bow's the CFO. He's come with a financing mechanism to help us to get better costs on our inputs and helped us to figure out how to get better prices for our outputs. And so we're going to be able to maybe think about how we have some advantage. Maybe we're a leader in the industry. Maybe we're more innovative. Maybe we have some monopoly power. Okay? There's something that lets us differentiate our firm's growth from the industry. Now, we wouldn't, if we had GDP growth at 3% and industry at 11% and some leadership advantage of 2%, that's not going to equal 16%. But it looks like it equals 16%. Why would it not equal 16%? Wes?
There's kind of like whack it's weighted, right? Like GDP isn't going to have necessarily the same influence on your returns as being innovative in the field or having a monopoly.
You're very close. You're going down the right rabbit hole. Okay. If our industry is expected to have an 11% growth, isn't it likely that the GDP growth of the economy is already baked into this? If this is our industry, then the GDP has already influenced it, right? So you have to think about what is cumulative versus what is informative, right? So the GDP change probably helped inform the industry change. Maybe we've said, I'm going to say this is now 13% because that was already cooked in. And then Karen's come and she said, we're going to go into some new markets. We've got this $25 million cash account. We've been saving this up from retained earnings for the last 7 years, and we're now ready to launch into China, and we're going to use the blockchain to do it as we create synergies. Okay? And we believe that's going to pump an extra 5% in growth for this year. And then Gunther comes up and says, you know what? We also have just brought out of research and development some new products that we've been spending the last 3 or 4 years. We've gone through FDA, yada stuff, and it's going to give us an extra 3% in sales.
About your currency hedging.
Pardon?
About your currency hedging.
Well, no, I'm not even going to get there with this one. So I think we're at 21%. And then the naysayer of the crowd, Mariana, comes in and says, but wait, you're forgetting, we've got 3 products coming off of patent. 3 of our pharmaceutical products coming off of patent. And everybody in the world is going to be able to replicate them. And even though we'll still sell lots of those drugs, we're not going to be able to get the current price for them. We're going to lose 4% to our bottom line, or to our top line. And so all of a sudden, we now have thought through the dynamics of our company, our products, our growth expectations inside because of our preparation, our capital resources. We've thought through the industry that we're in, we've thought through the economies that we're in, and we've decided we've got a 17% growth rate. Yippee. Now, it could be any set of numbers, right? It could be any set of conditions. I'm just trying to help you think about how you think about it.
Do you just take out GDP like that?
Would I?
Yeah.
Yeah, I did. Because my industry growth was probably already reflective of the GDP change as well, right? Because the industry is in the same economy that's experiencing this. So if you added both of them, it would be redundant.
What happens
Please.
What happens if, like, one of the products that you have on the patent is baked into what your monopoly is?
Well, then maybe that's part of why we're going to see such a big change. So I think it is. Yeah, we've got some advantage because we're monopoly providers, innovative, but we're losing something off patent. So it's going to cut into this whole thing. In fact, more than our monopoly was given us, right? So this is how you think about it. No 2 of these would look exactly the same. The hardest thing to consider here is which numbers are additive and which numbers are informative. So in this case, GDP helped inform the industry growth. We wouldn't use both of them because we would be overstating, right? Maybe this number, instead of being 2%, maybe this number was 20% proportionate. 20% proportionate. I see this all the time, where a company will say we have a leadership advantage that gives us an extra 20% over and above the rest of the field. That doesn't mean 20 raw points, so we're not going to add 20% to 11. We're going to take 11 times 1.2. That's going to give us 20 proportionate. So you have to think nominal versus proportional sometimes. It's all about the story. It's all about converting the words to numbers in a way that makes sense. And there's going to be 1,000 different ways of looking at it. Okay? That is the creative part. The rest gets pretty cut and dry. Let me show you. So we want to get to a point where we can forecast free cash flow. To forecast free cash flow, I need to forecast my sales. I need to be able to forecast my costs. And let's say for a minute that I've got, and I've actually got an example for myself here that I'll share with you guys in a little bit. Let's say I've got cost of goods sold. I've got S&A, sales and admin. I've got depreciation, which then leads me to EBIT, right? I then have interest expense. I've got invested capital. I've got no plat. I then have net working capital. I have fixed assets. Aren't you about to faint? I have free cash flow. And I also want to think about ROIC.
What? That didn't even fit in my page.
Well, you need a bigger page. Or you know what? If you just kind of take conceptual notes, I have all of this on paper for you.
Oh.
Okay? Okay. I also better think about my debt, because I don't know how to calculate interest expense if I don't know my debt. Okay? Well, I think we've got some things we can rely on. But we first have to know what some base numbers are, because we're about to grow something from something, right? So our base numbers are going to be the numbers from the year that we're observing. So let's say in this case the year we're observing is 2014. So it's going to be our base. And let's say in this case we've got debt, or rather sales, of 253.64. COGS of 211.46. Space that differently. 211.46. S&A of 29.64. Again, these are just coming right off the income statement. Depreciation 3.89. Okay. And now EBIT, we're going to be able to calculate. Now I'm going to tell you the interest we calculate. Our debt was 31.54 or 44. And the debt the year before was, let me find it here, 26.65. And you'll understand why that's important in a moment. And that was our debt for 2013. Okay? So when Lynn smiles that broadly, I know something's up.
Yes.
Are we okay here?
We're okay.
Is it just too many numbers tonight? Okay, all right. It needs to not be. Okay. Just to be perfectly honest with you. We're going to calculate interest. We're going to calculate invested capital. We can calculate no plat if we know that our tax rate on EBIT is equal to 0.34. Okay? Fixed assets. What do we have here that tells us how our fixed assets are changing? And we've got a number, to be sure. That number from the prior year was 46.93.
Your depreciation.
And net working capital, we also have a number from the prior year, 62.91. How do we think about changes in fixed assets and net working capital? And by the way, I'm using those because those are the inputs to invested capital, right? And those plus depreciation are the inputs to net capital spending. You could put NCS as a column on there, but it would be calculated, or you could just code it in. How do I think about changes in those? Do they change at the same rate as sales? Do they change at the rate of something else in the economy? What do you think?
Assuming, for the fixed asset, assuming you didn't buy anything new, it would just be your depreciation.
Well, I'm going to make the assumption that this company is active and dynamic, and it probably is buying new stuff.
Just take the average of the previous years?
Well, we can think about growth in prior years if we have enough of those years, right? Here's an interesting thing. I don't know that it's immediately obvious to you that there's a change that we've already articulated that is really driving our change in fixed assets and net working capital. If you look at the firms that's Dow 30 and the S&P 100 and look at their change in fixed assets and their change in net working capital, it tracks very closely with their change in sales. Almost dead on. Now, one year might be a little bit different than the other, but if we then average them, they're almost dead on. Well, that kind of makes sense. We've said this many times. A company creates its revenue from its capital assets, right? Unless it's a bank, an investment holding company like BlackRock, Blackstone, a real estate investment trust, or an insurance company. So a financial, okay? Which they typically create their revenue from equity rather than assets. So if we think about it, the change in our sales probably is going to be mirrored in the change in our fixed assets. They are interdependent. So I'm going to go ahead and I'm just going to say that as we move from one period to the next here in a moment, we're going to move net working capital and fixed assets at the exact same rate we're going to move sales. Okay.
Sorry, Rick, just
keep going.
Step back one step. If you're seeing an increase in fixed assets, but you're not seeing an increase in sales, then you're like
you're in trouble.
You're buying stuff and you're not using it to generate.
Or you're not using it efficiently, or there's a time lag. It's possible if I have an auto manufacturing plant, I might spend $300 million on fixed assets this year for an automobile that I won't bring to market for 2 years. But that's going to be something indicative of the industry I'm in, not because I'm inefficient, right? So you got to think about the industry you're in and time sequence. Pharmaceutical industry. I mean, their largest fixed assets become their patents, right? So as they capitalize R&D, but they're going to have to do research and development for years before they bring something to market.
Isn't that pretty much in every scenario with every company? Like you see fixed assets go up before sales actually start to increase?
Yes, but sometimes in some companies, the change is so close to each other, they're in the same year. I might put a new production line on right now, and that may give me new sales next month. Okay, I wouldn't see much lag there. So the industry dictates the lag, and it may be very quick and it may be very long. And we're pretty much going to assume it's just happening simultaneously in this case. Okay? Well, let me put up some numbers for the next year. So year 2015 in this case, I'm going to go ahead and put up, I'm going to say that my sales growth is, so my change in sales is equal to 8.6%. My example. Okay. Well, if I take 253.64 times 1.086, I get 275.45. Okay. But now, how do I get my cost of goods sold?
It shouldn't be the same percentage, right?
How come?
Well, you're assuming, I guess, again.
Well, I never challenge you when you're wrong.
If typically, I don't know, like for certain restaurants, they shoot for their cost of goods sold to be a certain percent every year, and going off of that, seeing what it was last year and adjusting it. Actually, not even adjusting it, taking it.
Maybe not adjusting it. Here's the key. Are we at a point in our firm that we have a constant returns to scale? Or do we have increasing returns to scale? Okay, so you're going to say increasing, which supposes that our company's not at maximum scale yet. We haven't reached critical mass. I'm going to suggest that the vast majority of companies that we'll ever deal with firsthand, that's going to be the case, right? If we buy 1 million units, we pay less per unit than when we buy 100,000 units. But if you're looking at large publicly held companies, they're probably at or near critical mass. And at the moment, we're going to assume this company has constant returns to scale. We're going to look next week at changing returns to scale, because it's quite a dynamic difference to have to model. You can think about it easily, but modeling it becomes challenging. Well, so how do I do this? Well, I'm creating a forecast ratio for every one of my expense categories. So in this case, I'm going to create a forecast ratio for COGS. I've noticed that in my base year, my COGS were 211.46 against sales of 253.64. And that gives me a ratio of 0.8337. All else being equal, not assuming anything but constant returns to scale, then my forecast ratio that was established based upon my prior years should hold true in the future. Now, maybe I don't take just 1 year. Maybe I'll look at an average of the last 2 or 3 years together, right? But in this case, we're just going to be taking 1 year at a time. But just know, as you get more sophisticated, you start dealing with averages. And you may be at a point even deal with weighted averages, all right? So how do I determine my cost of goods sold for the next year? I take and rearrange my equation. If I want to figure my cost of goods sold, I'm going to go ahead then and I'm going to divide. You know, I got to think about this structurally for a moment. This is my forecast ratio. Yeah. So my forecast ratio times my sales, in this case 275.45, my forecast ratio of 0.8337 is going to give me my cost of goods sold for this year, right? And that's going to be
29.64.
Thank you. I appreciate you doing it faster than I can read it. That's pretty good. So my sales and administrative expenses, I'm going to think about the same kind of thing.
Why would you separate sales administrating and not necessarily do like operating overhead expenses?
Great question. I did this just to be relatively simple. If you were doing this really, you would have a different forecast ratio for every expense line on the income statement. And the reason you would do those differently, even though you're about to see they're all going to change at the same rate, they're all changing at the 8.6% of sales, aren't they? Because we start out with constant returns, and then we start to think as managers. Is there something about our sales and administrative expense that we can improve on for next year? Can I get some best owner premiums? Can I start to get some advantages? So my forecast ratio for COGS was 83.37%. If I do the same thing,